I just think that we think about things so similarly, where we live in this world of cash flow. It's of high value because that is, in our minds, in many cases, a superior type of investment if it can support your lifestyle. But at the same time, through the lens of insurance, how do you get insurance in place to work alongside? How can you use insurance, specific, the properly crafted whole life
Right.
insurance, or uniquely non-term, generally just,
Right.
some sort of permanent life insurance that can give you advantages. Maybe it's premium finance, maybe it's PPLI,
Yep.
and where you can really use it to your advantage. And so you do such a great job of laying that out. In my book, it was my goal to be able to do that and show how I could do what the banks do, and have that fractional reserve lending where you take the same dollars, you invest them in two different places, you get two different returns. And so now it's exponentially greater.
Yeah, I mean, I think that, you know, PPLI is something that I've read about in other books, but like they scratch the surface. I mean, because you have to be pretty wealthy to jump into private placement life insurance. Where I remember I was talking to this guy, he was an insurance guy, and I was in my early 20s, and he talked about how he'd sold Donald Trump an insurance plan, and like a life insurance. And I was like, wow, like how long ago was that? What did you sell him? And I go, have you ever done more with him? He goes, no. His team figured out private placement life insurance and never needed me again. And I was like, what is private placement life insurance? So I start researching it. And that was part of like when I wrote What Would the Rockefellers Do? What Would Billionaires Do? Is like, okay, most people can't do that. So how do we design something as close to that as possible?
Yeah.
And the masses could kind of utilize. And premium finance is something that I've done in my own personal finances, where you get a bank to actually give you a loan, but banks don't love lending on real estate. That's not their preference. If they can lend on cash, that's actually a higher preference, which usually means you get a lower interest rate. So you can get like 1.25% of a loan from a bank to go into a cash value. So just like you get a bank to give you a mortgage on a home, you can also have them give you a kind of mortgage on a cash value plan. And so that's pretty fascinating as well. But most of my stuff is pretty straightforward, just overfunded whole life policies that I've used over and over again. When I was 19 years old, I started with $50 a month. By the time I was 20, I was doing $262 a month. And now I've got 26 policies between the ones on myself, my wife, my kids, and business associates. And that's been the way I store my cash. Instead of getting 1% in a money market account, I'm getting 4%. Instead of paying taxes, I'm not paying taxes. I can access my cash very easily. I've used it to buy a business. I've used it to buy real estate. I've used it to buy even more real estate. I've used it to buy crypto. I've used it to buy things that make sense based upon what's going on in the economy, but without the risk of losing the cash during downturns of the economy. This is the problem. When people are overly leveraged and invested in things that are volatile, some of the times the best opportunities are when things are down, and they don't want to cash out things when they're down. This is my stability fund. And even if it's only getting 4 or 5% tax-free, I know I can tap into that at any time. So it's kind of, I look at it like as my medium-term storage. I still use, a little bit of cash, a little bit of gold and silver for like really short-term stuff. But this is the stuff where I'm going to have an allocation that I need to get to the money within a week, but I don't need to get into it in the first hour, or it's not what I'm paying bills out of or paying payroll out of. So it's really kind of that middle strategy for me.
Yeah, and technically you don't ever have to pay it back. So let's say you hit hard times and, bills are tight. Well, you don't have to pay this back. This is a repayment to yourself. So at whatever point in time that you do die, it would just be taken away from the death benefit.
Right.
So it's really a unique strategy. Yeah. Tax-free death benefit, tax-free distribution, tax-free growth. There's very few investments, if any others, that give you all three of those. And I think that's, part of the reason that it drew me in and why I wanted to start utilizing these policies. And I did this early on. When I started getting into mine, people around me thought I was crazy. People told me that this is the worst decision that you've ever made financially, because I was single, I wasn't dating anyone. So it wasn't even like I was close to getting married. I had no kids, but I saw the way that the numbers worked. And I also knew other wealthy people that were doing it. And I was like, hey, if they're doing it, there's probably a reason. And so that's when I really started digging in. And the other thing I like about it is there is a guaranteed return that is fixed. So you have the opportunity of upside if they do well managing the money with the dividend, but you have a floor that you're going to not earn less than. And that's different than the numbers you get from portfolios or financial planners, when you have money in the stock market, where it gives you an average rate of return, which is very manipulative. It's not a true return. It's only averaging it out. And so it's not the actual return you get. It is really just a shame that can be used and promoted, but it is. And so I like having an actual return of what you really make. I think that's important.